Hi everyone, thank you for joining us on today's podcast. Today we have a very established professional from the alternates industry, Mr. Chockalingam Narayanan. Mr. Chockalingam has over 2 decades of experience in investment research, fund management and market analysis, and he currently works as the head of equities for PMS and AIF with ICICI AMC. Thank you so much for joining us, sir.
Thank you. Thanks to Team FPS for inviting me, and very honored to be on the podcast.
Thank you, sir. Sir, I would like to begin with the first question on one of your statements, right? You had mentioned that value investing does not necessarily mean that you buy a mediocre business or a mediocre company at a bargain. So something on that.
I actually don't know where I made that statement, but I think one or two people have already asked me on this. But yeah, when we think about businesses, what we essentially think is thinking about stocks. We ideally think that stock returns are made out of two things, which is basically price is equal to EPS into PE, which is earnings per share into price to earnings ratio. So you need one of the two things to work. Essentially, in the value style of investing, our sense is, while people typically wait for the re-rating to kind of happen, that trigger that we historically, at least as far as the Indian markets kind of go, what we've effectively seen is that it tends to work when the earnings growth kind of starts to make a little more sense. So that is where we think that what tends to typically happen is why do businesses or stocks tend to be available at a fair bit of discount to what their intrinsic value is effectively because there might be something or the other which is kind of lacking. So and more often than not that tends to be there with businesses that are run a little bit mediocre. So just because it's mediocre and available at that valuation doesn't mean that you have to get into every such name that you...
Doesn't mean that it's a great buy, essentially. Understood.
So how do you kind of then figure out which are the ones that can actually work and which will tend to move is where we have to really work hard and figure out where could be the earnings turning point somewhere down the line. So that's what one needs to focus and understand. And if there is some semblance and some signals towards that, then that's where we focus our attention to our efforts into and try and understand that. So sometimes it will test you, but the reason is a few of the aspects which could tilt the turn is it could be cyclical businesses where you could be at the cost curve. But when will the pricing kind of improve for the cost curve to kind of make sense, that's anybody's guess. There you could wait a little longer, but as long as you were the lowest cost producer, then you tend to be at a better position. So that's why you don't know the timing, but then you kind of take calls based on that. Yeah.
Got it, sir. So something about you. You have an FRM background, right? So typically when you're an FRM, you tend to look at things from a risk management perspective through that lens, right? How is that impacting or rather, if you will, or rather helping your decisions in terms of equity decision?
See, some of these graduations, help. It helps you give a structure to how you kind of think and look at it.
Right.
But learning doesn't stop there. It's always it's kind of quite continuous. Even if there was an FRM degree or not an FRM degree, I think in this business particularly as far as investments goes, it's a lot more about process and discipline, and an element of risk management kind of helps you be a more rounded investment professional. So subconsciously you might be running a few risks, so it's useful to kind of understand through data what are the sort of risks that you're kind of running. I think the different institutions where I've kind of worked have helped shape that along with my graduation in FRM. I think it's also more practical application which is important.
Right.
That's very, very useful to understand.
Got it, sir. Now getting to the topic, right, on the alternates industry, let's say PMS for that matter. So it's a very different animal when you compare it to a mutual fund, right? So how would you compare this against running a mutual fund portfolio, running a PMS portfolio versus running a mutual fund portfolio, if you will?
I would kind of use probably two analogies. One is obviously that we keep repeating it in multiple forums, but at the cost of repetition, we would kind of say it again, that investment profession is very akin to the medicine industry actually.
Okay.
You have asset manager who are like the pharma manufacturers. You have advisors who are like the doctors,
right?
Because they understand their like how a doctor understands their patients very well. The advisors understand their investors much better, because the level of interaction is a lot more closer. And everyone's needs and requirements are kind of very different. Everyone's investment horizons are very different. So that's one part of it. Second is it's also fundamentally, when the second analogy is that when you kind of think about it, you could eat anywhere. You could eat at a Udupi restaurant. You could eat on the street. You could eat at home.
Right.
You could eat at a 5-star. You could eat at a fine dining place. You could eat at multiple places. The basic need is eat.
Yeah.
But how it gets served is very different. The experience is very different. Mutual fund is a hugely, I think it's a fantastic platform which both SEBI and the industry have done a fantastic job of inculcating the habit of investing into the markets in the country. It allows people of every strata to kind of participate in that, and in that sense there is nothing which is more ubiquitous than a mutual fund. But when people when their wealth starts to increase, there are people who would want a certain higher allocation to possibly a higher active share portfolio that they would want. It is not necessary, but then what they are seeking for is higher active risk to be taken, and if that can be commensurately rewarded through higher returns. That's the idea. So which is where a solution like portfolio management services actually comes into the ambit of where one could invest. So in that sense, the set of investors who are there in a PMS is slightly more, you could say, more homogeneous in terms of set of investors who are there, because the ticket size kind of tends to be slightly different.
Right.
Whereas in a mutual fund, you're basically running the same portfolio for whether an investor is of a small ticket size or a big ticket size, doesn't matter.
Right.
So you tend to be a lot more benchmark aware, is how I would kind of call it when you're running a mutual fund portfolio.
Okay.
Here you could have the based on your one-to-one interaction with the investor and the advisor, you can run a more customized solution. So that ability is something that PMS brings to the table. So it's not either or, it's and. That's how I would kind of put it. So for different needs, there are different solutions. And that's where that difference kind of lies. Yeah.
Got it, sir. So you spoke about active share, right, or active management of portfolios, if you will. So how do you justify this to a client exactly? I mean, any words on that?
I think one does not need to justify. There is a certain need. The primary purpose that somebody would consider a PMS as a solution is if they and their advisor kind of find it as a suitable solution for them.
Correct.
Now when they've come in with that kind of mandate, then it is implicit that they are looking for something which is different from what is already there in the market in a standard product, which is where that active share is likely to be taken. So if you kind of look at classical finance literature, you would kind of see that there is that efficient frontier portfolio, and there is a certain level of diversification where it kind of makes sense.
Right.
Which is where if you can run a tight portfolio but with the right amount of sweet spot of diversification, that number could differ for different markets, different market cap criterions. It could kind of differ, but where the sweet spot kind of lies is where we would ideally want to run the mandate, and we have the discussion with the investor and the advisor, and if it kind of resonates with them, that's when they entrust us with the responsibility to manage their money. So we're thankful for that, but we have to stay true to the mandate.
Got it. So I would want to pull you towards another statement that you had made. Look beyond emotions, right? Again, so I would want to know if in any recent market where the market's emotions got the better of it and it read, let's say, the earnings movement in a different way. Can you cite any example that you saw recently where the market's read of the emotions, right, because of its own emotions, actually went wrong, and how did you position yourself in that context?
See, it's very difficult, right, because when we're talking about market, it's the collective mindset.
Which includes everyone.
Yeah. So in the short run, it could be one way or the other. But when you kind of take a slightly more longer term horizon, they tend to be right. And the reason for that is equity is a higher risk asset class because you're part owner of a company. So like a owner, however the cash flows of that business change, it could be a change in an input cost, it could be a change in an employee cost, it could be a change in a par cost, it could be change in interest rates that you're taken on the loan to support your business, or it could be a change in technology and the depreciation kind of impacts, or the tax rates kind of change, or dividend rates kind of change. So it could be multiple different factors. Effectively, whatever happens there, if you're not able to pass on that gain or pain to the customer of the business, then that business's cash flows tend to go through volatility.
Right.
The entire 100% of that volatility kind of flows through. So which is why as an equity owner, because you're part owner in the company, your cash flows see a huge volatility. Which is why in the short run you have that volatility, but in the long run what matters is earnings, and earnings tend to keep pace with cash flows in the long run.
Right.
So which is where, while there might be volatility and standard deviation which tend to be a little more elevated in the short run, in equities you tend to give yourself a better chance if you give for a slightly longer horizon. That longer horizon is not a set period. It will ideally be one cycle. That cycle could be 3 years, 4 years, 5 years, so it could be very different.
Right.
But in the long run, what we've kind of observed is, if you kind of look, I think the data is, if I look at the last 24, 25 years in the Indian equity markets, if you kind of look at what's happened to the index returns, what's come from earnings and what's come from PE rating, hardly anything has come from PE rating.
Right.
At the index level.
Right.
Like 95-97% of the returns have come from earnings. So as long as earnings, you have a focus on earnings, and that has to be obviously matched with cash flows. The cash flows have to keep pace. Then you're in the right direction. So temporarily you might go wrong here and there, but then in the long run, then economics will come back into play. Let's say, for example, the recent episode that everybody would kind of resonate with is the war itself. So the moment the war kind of happened, everybody thought that all the travel businesses were gone for they're going to take a big knock. Yes, they did in the short term.
Right.
But then there are certain inherent businesses where, if you're the cost leader, for example, your peers will take a knock faster. So your ability to gain market share tends to be a little more elevated during this period.
Right.
So what do you do then? You ideally start positioning yourself into some of these areas where you think the staying power of the leader in that particular industry, which is the most disrupted, is better. But then you'll have to size it. You have to. So there are different aspects to it.
Right.
But the idea is there is a certain dislocation in the market at that point in time. But in the long run, will it come back as the hypothesis? If you believe that that hypothesis holds a higher probability,
right.
then you kind of position there, and then and when that event kind of reverses, then you make money. So that's how we've historically thought about it. This is just a small example, but
understood.
Yeah,
understood. So since we are on that topic in that context, how do you differentiate a genuine structural growth story against, let's say, a crowded narrative, if you will, right? Because you hear things in the market, you know there's a lot of action in that specific segment, whatever it is. But then, let's say it could be a structural growth story also, like what we have seen in the AI segment for matter, right? So just an example, but then how do you differentiate between, like, let's say, a narrative versus an actual story?
I think what will typically be very useful is follow the consumer.
Okay.
Or the user. If it's a B2B business, the user.
Right.
If it's the, but then ultimately, even for that B2B business, ultimately the consumer has to. So you'll have to follow the consumer, but then with unit economics in mind. Unit economics, if it is not there at present, but if there is visibility that unit economics can come through at a certain scale, then you kind of start to work on it and figure out, and then look at it, which is where one could say, the ability to identify. And what also happens is competition is not sitting silent. So you'll also have to think about, something might look structural at this point in time, but then if you make too much returns or too much margins, then you're basically, again, classical economics, that you will invite competition, and then the competition will come and eat away, keep chipping away, right?
Yeah.
So, which is where the ability to, if it's a tech-oriented business, ability to reinvest into R&D is something which is very critical. If that is being, foregone for some temporary margin management, then that's not an ideal situation to be. If it's a consumer-oriented businesses, then share of mind and share of voice sort of investments need to go. If those don't happen, then again those are some sort of indicators to you that as an investor that hey, this is going okay for now, but then it can't chug along this way, because there are enough smart people out there, enough smart entrepreneurs who are out there who can come into that business if there are too much attractive profit pools which are available, or if the market is, for example, sometimes giving very large market caps to new ideas, then everybody would want to enter that space. So I think the market forces kind of ensure that nothing is structural for a very long time.
Yeah.
But then one way to kind of think about it is, if you don't make too much money, possibly, you won't invite competition that easily.
Right.
So
understood.
So
kind of like a paradoxical situation, right? In a way, right?
In a way, it is paradoxical, but that's one useful way to kind of think about it. Yeah.
Understood, sir. So I would want to know what's your self-discipline like, right? Because as you would definitely agree, because fund management is a probabilistic game, right? So you get probably 6 to 7 ideas out of 10, right? You're better than most.
Yeah.
So let's say when you develop a thesis and it goes wrong, it doesn't go as you expect, when do you admit or when do you understand that the thesis went wrong, and do you actually go ahead with selling it, or you give it time. Anything on that?
At our end, we do selling for three reasons. First is for, if your hypothesis is basically gone wrong.
Right.
Now, if the hypothesis has gone wrong for reasons driven by market forces, but company is doing the right things, then you're willing to wait.
Right.
But then if your view is that that's going to take longer to kind of rectify, then there's no point. You cut your losses and you're out. If it is due to company's own doing, then it's an even easier call that you cut the losses and kind of move it. The second way to kind of correct is basically risk management, which is what we call sizing.
Right.
So your hypothesis might be playing out well, everything might be playing out well, but sometimes what happens is because sometimes cash flows come a little ahead or with a lag.
Right.
So if they come a little ahead, then there is likelihood that competition can take note and impact the business with some amount of competitive forces, right? So then you'll have to also think about that risk is now increasing. Can you size the position with that aspect?
Understood.
Third is if it's played out much ahead, then you basically say, this is done. Thank you for doing the work, and you move out. Yeah.
Understood. So how much does your so we all know you use macros as well as bottom up to bring in ideas into the portfolio. So where do you find the balance? How is your idea going to be derived out of a macro view versus a bottom up thinking? So something on that discipline, if you can.
So everybody has their own nuance and everybody has their own way of doing it. So while macros play a lot of important role, what we inherently believe, primarily looking at equity markets as a field, I would say the asset allocation decisions are largely already done at the because I'm primarily here talking about PMS and this part, right? So here, ideally, the asset allocation is already done by the advisor and the investor. So it's only the equity money that kind of remains. So if the markets are, for example, expensive, they've already taken a call that equity portion is lower, and if the markets are cheap, they've allocated higher. So that part is thankfully taken care by the advisor and the investor. So it's only the equity portion that kind of comes to us. So there, then we kind of think about it. While macros do play a important role, I would say 70-80% of the work is actually done more at the bottom-up stock level. The reason is even if the macro kind of turns, if you've identified a very strong company, they will find a way to navigate through that. Maybe the return that you expected might not play out as much in the macro environment that you did not anticipate.
Understood.
But then they'll still make a decent job in that environment.
Right.
So and the other element is when you pick companies bottom up, there are also certain common threads that you can kind of pick up on macros from the companies.
Right.
So it's also sometimes useful to pick up those cues.
Okay.
When you do your research from either typically the most important cues tend to come from working capital.
Right.
That cycle basically kind of gives you
the macro view essentially.
The entire queue in the market is basically given from the cash flow cycle, right? So you tend to pick up cues more from what's happening on ground in terms of whether what's happening with a distributor, with a vendor.
Right.
So that kind of work when you kind of do, it's actually more bottom up work that you're actually doing, but then you will get cues on macros.
Through. So that's actually very interesting. So because you pick up macros from micros in a way.
Yeah. So it works both ways.
Hand. Yeah.
It goes both ways.
Right.
Because there could be certain things which could be done on the macro level, but then it might take some time for it to get transmitted. So which is where then you kind of figure out. So you'll have to always be having your ears to the ground, understanding. So which is where having a large research team kind of is of a immense help. So thankfully in that sense we have a huge research setup at ICICI Prudential. So which is where we cover the amount of stocks that we cover, have the widest coverage on the street, only for our investors. So in that sense, those are aspects that that we tend to benefit from while doing this work. So
understood, sir. So we all know markets are typically never at equilibrium, right? They're either overstated or understated, and any specific consensus thinking or any sector or bet, whatever it is, right? Where do you think that it's overblown today? At least any sense of that, if you could give us, it'll be great.
No, so today with the way the investment world has kind of evolved with mix of passives, mix of things like small case investing and narrative investing and those kind of things. The movement in some of these trends and counter trends kind of is actually quite fast.
Okay.
So that's actually both an opportunity and a challenge.
Understood.
So which is where it's all the more important to understand where is the cash flows of the business that you're kind of tracking, and so it's more hard work.
Right.
But the one thing that I would say is maybe this was because of the period between 2007 and 2021-22. In that entire cycle, if you kind of look at it, interest rates were pretty low. So everybody picked businesses where there was a lot of predictability. There was a lot of and as long as predictability was there, because the cost of capital was very low, so the valuations were very punchy, right?
Right.
So everybody ignored cyclicals.
Right.
So it goes through. So you can actually do. People typically think that you can only trade in cyclicals.
Right. That's the common view.
That's a common view, right? It does not necessarily have to be the view. I would say you can invest in cyclicals also.
Okay.
But that cycle could be a little longer.
And lumpier as well.
But then if you get the direction right, there's actually a lot of money to be made in cyclicals.
Right.
So which is where I would say that that's one area where I would think that you don't always have to go with only the most predictable businesses.
Right.
You can do a lot of work in cyclicals, and so that's probably where I would kind of say that that's slightly different.
Understood, sir. So amongst the alternates, right, PMS and AIF, they are getting a lot of traction amongst the affluent population today. See, in this boom, there's obviously in every boom, there's something that is misunderstood or that hides underneath that people don't take look at. So in this boom, what do you think is something that people are ignoring very easily?
It's not only, it's basically a cycle. People come with a bit of a, I don't know whether to call it a return chasing mindset or not.
Right. Expectation.
Yeah. So I think because a lot of money was made in 20 to 24 phase.
Right.
People expected the same thing to kind of continue forever.
Right.
That's not necessarily the case. The reason 20 to 24 happened was also because 2010 to 20 happened.
Right.
So if you look at 2010 to 20, the earnings CAGR was actually very, very moderate. Despite the country kind of continuing to grow anywhere between 10 to 14%. I think the starting of that decade we kind of grew at 14% nominal GDP also. Then inflation kind of came down. So between 10 to 14% was the nominal GDP. But markets, I think, gave 3-4% sort of CAGR in that entire decade.
Right.
So there was a catch up to be had. So when the earnings kind of came back, earnings normalized, all that. Markets also kind of, so the period between 20 to 24 had a earnings CAGR, if I'm not wrong, between around 35% at the NSE 500 level.
Right.
So which is where the returns also were broadly commensurate.
Right.
Now after 24 we went again to a normalization phase. So the normalization phase meant the earnings were more closer to the nominal GDP at that point in time.
Right.
So which is where we had a period where, because the earnings growth didn't happen and there was a little bit of valuation you can say overhang, it kind of corrected. But today if you kind of look at the last 21 odd months since September 2024, right? So I think markets haven't done much. During this period the country has continued to grow. Earnings have actually made a decent comeback. So, and if you look at large cap, mid cap, small cap, while at an index level large cap and small cap are broadly around the averages and mid cap is slightly on the at a premium, what you would see is that underneath the index, basically if you look at the index constituents, we were just doing some data crunching. What we realize is companies that have created, stocks that have created or rather that have corrected more than 20%. That number is almost like 54-55% of small caps, almost like 50% of mid caps, and about 30% of large caps.
Okay.
So while at the index level there might be a certain narrative,
Right.
underneath, if you're willing to do the research, there are enough opportunities available, but obviously it's slightly more harder work. When the valuations are easier, the work to be done is also a little easier. Whereas here you'll have to do a little more hard work. But then that's where the opportunity kind of lies. So in that sense, we remain constructive, and here we only need in a thing like the field of portfolio management services or AIFs that we kind of look at. We are only looking for a tight portfolio, so we don't need like a whole bunch of ideas. So in that sense, if you
made it easier for you, typically, if you will,
but the room to make mistakes is also lower because it's all concentrated positions. So you'll have to do a little more deeper work before you size up. So it has both its pluses and minuses.
Got it. Absolutely. Also, question on ICICI right now. It's, despite being a mammoth, right, it still goes strength to strength against the PMS boutique firms and relatively smaller firms, because PMS as a structure, when you're a little relatively smaller, you have your own advantages in terms of, let's say, performance or let's say growth, whatever it is, right? So, but ICICI still has managed to keep up with the boutique firms today. In fact, we've covered this in our PMS intelligence report called the PMS Chronicle from FPS Assets. The research team has done quite a good amount of work on that front. So something on that. So how has ICICI managed to keep this up?
Yeah. No. So first of all, kudos to come out with a product like this. It's an important development that more people kind of cover the industry as well, right? So in that sense, it's a great initiative. Thanks to you and your team.
Thank you, sir. Thank you.
So on that aspect, with coming to ICICI Prudential, I think the organization has invested in senior resources and talent, and been very serious about this offering, which is why the sort of investments have kind of gone into this thing, and with an eye towards giving investors good investment experience through cycle. Now, where the huge benefit that we draw from is the large research team that we kind of have, because they anyway day in day out kind of keep working on identifying stocks. So that army actually, we call it the army research army actually.
Okay.
So that actually covers a whole bunch of stocks, the widest coverage on the street.
Right.
So in that sense, that's a huge benefit. So one layer of work is done by the research team. after that, a seasoned team of portfolio managers kind of works on those ideas, and then depending on the investment mandate that we kind of have, what fits that, we work on it. We have our in-house investment philosophy called BMV on the alternate side of ICICI Prudential. So business management and valuation.
Got it.
So we work on it like a checklist as to certain things need to be there, and then we work on it. So it's a very process-oriented approach to investing, and we really encourage a lot of counter views, because when we take concentrated positions, we need counter views more important than taking the view itself.
Correct.
So in that sense, there is a fair bit of camaraderie within the team, and we've been able to develop that over a period of time.
Amazing.
And that has helped. Being very process oriented has helped give investors this sort of experience. Added to that, we've had huge investments into other areas, not only on the investment side, but also on hand-holding with regards to the on-ground support for advisors and investors in terms of the sales efforts, as well as there's a risk management team that kind of functions, and they have a very independent view of how our portfolio looks and how it needs to, what sort of risks it carries, and what sort of things we need to be aware of. Then there is a huge operations team, which that's the backbone, along with our research, I would say, for us to kind of enable this. So which is where we call ourselves a boutique within an institution.
Amazing. Yeah.
So we want to give the investors a experience like a boutique, but in an institutional manner. So that's how it is. So yeah.
Amazing, sir. So being the diligent person that you are, I'm sure you would have gone through the entire document, our PMS Chronicle. Just a couple of insights or any feedback that will help our viewers maybe.
I think it kind of highlights where the industry trends are kind of shaping up,
right, sir.
And who's offering what sort of solutions, and how is it different from the others. So I think that is very, very useful for investors and advisors to kind of think before they take their decision. So I think it's a very, very, and it's useful for asset managers, for us also to kind of have a view of what sort of solutions are there in the market. If something is in trend, something is not in trend, it's useful for us to also understand, because at the end of the day, we need to be mindful of what our consumers want.
Amazing.
So if we don't, then that's a risk for us as well, right?
Correct.
So it kind of adds value to the entire ecosystem, to all stakeholders. So in that sense, a great effort, and keep up the good work.
Thank you, sir. Glad. Just a couple of questions. I think we had a brief conversation before the start of the interview on how does your typical day go, right? So I would like to pick your mind on what is this one habit that you would say that made you a better investor?
I don't know. I think there's not one thing, but I would say hard work is like a prerequisite. Humility and mutual respect with team members who actually differ with you.
Yeah. Absolutely.
So that's like very, very important. So that is something that I kind of like, working in teams where people have differing views.
Understood. Wonderful, sir. So we've come to the final question. It's more on off investing, right? What is this off investing thing, or rather, investing success is one. Obviously, it comes through many forms. But how do you define success of investing, right? For someone, let's say for our young viewers who are looking at it, and something on that.
No, I think start early.
Okay.
That's something that I would say is, earlier you make mistakes with a smaller pool of capital, the learnings are faster.
Right.
And don't repeat the mistakes that you've made. Have the diligence to not repeat the mistakes that you've made in the past.
Right.
Learn from it and not repeat it.
Understood.
I think those are the two things, and don't be afraid to take risk, because not taking risk is also a risk.
A risk in a way.
Yeah. So
this applies across, right? I mean, investing or not investing, I think these are success mantras for life, if you will, right? Amazing. Thanks a lot, sir. Thanks a lot for giving your time, and I think our viewers would have got a good amount of idea on what goes on into the investment manager's psyche, right? Amazing. Thanks a lot, sir. Thanks a lot for your time.
Thanks a lot.
Thanks.